Welcome to the ninth lecture of Unit 2 in the Ethan Trades Mentorship. In this lecture, I will be introducing the bread and butter model we will be using to trade. This will help you determine the narrative of price, as this will help you become flexible and make discretionary decisions in the market. Something that you will often hear me talk about is the narrative price is in right now. In the context of ICT trading, the narrative of price refers to the story that price action tells as it moves through different levels and patterns on the chart. This narrative helps traders understand the underlying market structure, the intentions of smart money, and the likely future direction of price. In a nutshell, it's the why price is moving the way it is. The main components that make up narrative are the fundamentals that will be taught in Unit 2. These include market structure, institutional order flow, and liquidity. We pay attention to each of these components and use them in complement of each other to determine what the market is trying to do right now via historical price action. To build narrative, we can ask ourselves questions in relation to each component. For example, for market structure, we can ask, where is price within the current range of premium and discount? For institutional order flow, we can ask what levels is price currently respecting or disrespecting. For liquidity, we can ask what is the draw on liquidity right now. We'll revisit how to build narrative later down the mentorship as well, but once again, I have included this earlier on to get you to start thinking about the bigger picture of price. By understanding and interpreting a narrative built from these components, we can make informed decisions about entering, managing, and exiting trades. Narrative allows us to align our actions with the likely behavior of smart money rather than following a mechanical strategy. Think of each trade idea like they're puzzles. Each trade idea represents a unique puzzle picture, complete with its own distinct final image. However, the pieces that make up each puzzle are often similar in shape and form. Just like in puzzles, these pieces in trading are like each individual concept that's going to be taught through this mentorship. When you approach a new trade, it's like starting a fresh puzzle. You have the image of a successful trade idea in mind and a collection of familiar pieces that will need to fit together in a specific and the right way. It's not about concept A, then concept B, then concept C equals profitable trade. If it were that easy, everyone would be rich through trading. The goal of this mentorship is to, of course, teach you how to read price, but in order to be successful in the markets, you have to be flexible with your analysis. It's like having a bunch of tools and knowing when to apply the correct one at the right time. They can happen in multiple different sequences, so you never know which tool you'll need until it presents itself. With a strong understanding of narrative, you can literally enter in direction of your bias anywhere in the market and make money. As mentioned previously, top-down analysis is combining higher timeframe analysis with lower timeframe analysis. To make this concept even higher probability, we will be combining 3 layers of timeframes to create clear-cut confirmation when price is moving in one direction. In this slide, I have included the timeframe alignment that suits each type of trader's personalities. Long-term traders typically hold their positions for years or more. This is the traditional type of investing you see promoted in school, where the trader would purchase an asset and hold over a long period of time. You can categorize these types of traders as long-term investors. The higher time frame for long-term investors would be the yearly time frame or higher, the intermediate term time frame being the monthly time frame, and the lower time frame being the daily time frame. Position traders typically hold their positions for weeks to months at a time. The higher time frame for position traders would be the monthly time frame, intermediate term time frame being the daily time frame, and lower time frame being the 1 hour time frame. Swing traders typically hold their positions for days to weeks at a time. The higher time frame for swing traders would be the weekly time frame, intermediate term time frame being the 4-hour time frame, and lower time frame being the 15-minute time frame. Day traders typically hold their positions for hours at a time, entering and exiting a trade within the same day. The higher time frame for day traders would be the daily chart, intermediate term time frame being the 1 hour time frame, and lower time frame being the 5-minute time frame. Session traders typically enter and exit their positions within a session of the day. Each day is comprised of 4 sessions: the Asia session, the London session, the New York AM session, and New York PM session. Each session is 6 hours long, making up the 24 hours in a day. Starting at 6 p.m. EST every day is going to be Asia, then London, then New York AM, then New York PM. So for example, if a trader entered during New York AM session, they would be out of their trade by the time New York AM session ended. The higher time frame for sessions traders would be the 4-hour time frame, intermediate term time frame being the 15-minute time frame, and lower time frame being the 1 minute. Lastly, we have the scalpers. Scalpers typically hold their positions for no more than a couple of hours. The goal of a scalper is to get in and get out of the market as soon as possible and profit on the small fluctuations of the market. The higher time frame for scalpers would be the hourly time frame, intermediate term time frame being the 5-minute time frame, and lower time frame being the 15-second time frame. And of course, because price is fractal, this can all be expanded to a longer time frame or even dissected into a smaller time frame. Since we are newer to trading, I would assume if you're going through this mentorship, I would highly suggest going for day trading because that will be the most comfortable. And eventually, our goal is to go into longer term trading. That way we can scale our capital more comfortably. So right now, for example, I like to swing trade my personal account, catching the high of the week or low of the week and exiting on the opposing high or low of the week. As a day trader, I pretty much hedge my position as a swing trader. And so I can make back any potential losses if I do take any as a swing trader. Vice versa, I can make back any losses if I make as a day trader when I swing trade. And so I'm pretty much hedging my position and capitalizing on not only the large movement of the week, but also capitalizing on the small movements of each day during that week. In this schematic, this is the bread and butter model that all ICT traders follow. It doesn't matter what entry model they use, the narrative will always fall back into this diagram right here. As you haven't learned all the fundamentals yet, but you now understand market structure, I've included this schematic so that moving forward you understand that this is the end all be all. This is the fully zoomed out picture of what we will be trading in price action. The higher time frame consists of a range, usually. This tells us where we are currently in relation to premium and discount, so we know when to expect continuations or reversals on the lower time frames. Of course, on the lower time frames, you can still apply market structure to guide where price is currently trying to reach, but generally, the intermediate term time frame consists of a market maker model as introduced in the previous lecture. And so we look for this price pattern to occur whenever price trades into a discount of a bullish range or a premium of a bearish range. And so in this schematic right here, you can see on the higher time frame, we have this range delineated by the black line. On our intermediate term time frame, we want to see a market maker model form into discount. And once we have that smart money reversal, if we have that impulse structure, we can use a lower time frame range to gauge the trade into the origin consolidation or a distribution phase in terms of a market maker buy model. Vice versa, on a bearish range, right? This black line once again delineating the higher time frame, looking at the overall range of the market. And so on the intermediate term time frame, we want to see a market maker sell model from a premium of a higher time frame. And so once again, that smart money reversal, if you have that impulse structure, you can draw that range out and use that to gauge your entry. Last but not least is the lower time frame. The purpose of the lower time frame is to identify good entry opportunities. This is where entry models are applicable, but to keep it simple, think of the AMD schematic. This will always be present when you're about to enter a trade. In my opinion, the lower time frame is not always necessary, but it is nice to refine your positions so that you can have better risk to reward. However, if you were to just use higher time frame to intermediate term time frame, this is completely fine, and you just trade that by itself. To refine your entries as you get more advanced as a trader, I would suggest using 3 time frames. What would make this even higher probability is if the higher time frame is a market maker model of itself, and once it trades into a premium of, let's say, this impulse leg, it creates another market maker model within a market maker model. So you majority of the time want to see at least 2 market maker models stacked on top of each other from higher time frame to intermediate term time frame. So now that you have been introduced to the bread and butter model as well as time frame alignment, this is an analogy to further simplify the role of each time frame. The higher time frame provides the big picture view. Think of it as a big map showing you the entire world. You can see the continents, countries, and major landmarks. It helps you understand where you are in the world and the general direction you need to go. Just like in the market, it helps us understand where we are on a larger scale and the general direction price is headed in. We use institutional structure to figure out our higher time frame range majority of the time. The intermediate term time frame provides more detailed directions like a GPS. Imagine using a GPS while driving. It gives you specific direction and updates in real time. It helps you navigate through cities, highways, and intersections, telling you when to turn or if there's traffic ahead. In trading, it helps us frame our trade ideas in context of the higher time frame narrative. We use market maker models on the intermediate term time frame to develop a clear trade idea and develop our narrative further by aligning it with the higher time frame. The lower time frame is essentially the driver in the car, or like I previously mentioned, this could also be your intermediate term time frame if you want to keep it simple in the beginning. As you progress as a more advanced trader, then the lower time frame would be essentially where you want to be at to refine your trade so you have better risk to reward. The lower time frame helps us make the decision whether to execute on the market or not. The driver in the car follows the GPS directions, but also reacts to immediate conditions like traffic lights, pedestrians, or sudden stops. The driver makes quick decisions to steer, accelerate, or brake, ensuring a safe and efficient journey. Just like being the driver in the seat, you're the trader pushing the button. The lower time frame is the final piece to the puzzle of your high probability trade idea. Once all 3 layers of time frames are in alignment, that's the signal to push a button and manage the trade accordingly. So to sum it up, the higher time frame shows the long-term direction of the market. The middle time frame provides detailed guidance and keeps you updated on the current path price is taking. Last but not least, the lower time frame helps you make quick, precise decisions based on immediate conditions. When all 3 layers of time frames are in agreement of one direction, that's high probability. By using all 3 time frames together, you can see where the market is going overall, navigate the current market conditions, and make timely trading decisions. And once again, everything that I talked about the lower time frame can be applied to the intermediate term time frame instead. So you just have a higher time frame to intermediate term time frame, which works perfectly as well. Back on the chart here to give you guys a idea of what we're looking for in price when it comes down to this model. And I wanted to give you guys some live examples here as well and my thought process behind doing it. That way it'll help you guys start building up your journal, your study journals, and annotating moving forward in this mentorship. And so starting here on the 12-month chart, which is 1 year chart, each candlestick it represents 1 year of time, just to really exaggerate and go to the highest time frame possible to show you guys that this concept works on pretty much everything. And so starting on the 12-month here, you can see that price from this low is responsible for sending price all the way up here, and then this high completes that displacement. And so you have this low to this high, that displacement on the 12-month chart. Price trades back into the equilibrium or discount. It just touches it and continues higher. And so we're going to be dissecting this piece of price action right here, because you'll see that this down move and this up move translates into a market maker buy model. So now on the monthly chart, you can see how we have a curve here. It'll be more clear if you went on the weekly chart, which I will drop down to, but just know that here from a monthly chart within the context of the yearly chart, right? We can see that there's already a market maker buy schematic here. And so this is exactly what we're looking for. We're waiting for price to trade back into a discount or to fair value, which is equilibrium of the range. So here I'm back on the yearly chart, we traded down into it. Because this is such a long-term perspective, you can expect downside here because you have this market structure shift, right? So once you have this market structure shift, you can expect, right, just from this framework alone, you're going to expect bearish price action for almost 2 years here, right? Sorry, almost 1 year. This is 1 full year of bearish price action. And so from this high to this low, I can just draw it out again. This high sends price down to this low. That is all equivalent to approximately 1 year of price action. And so you would know that this was not a good year to buy any stocks at this time in price. And so understanding that, this is what I want you guys to annotate. This is the model. The model is understanding the higher time frame range and then looking for price to create a market maker model in alignment of your higher time frame narrative. In this case, we have a market maker sell model from the high of this range back into a equilibrium or discount of the higher time frame range. Once we reach that, we get another market structure shift right here if you want to use this one, or you can use this one as your market structure shift, confirming the smart money reversal, right? And then that would be from your equilibrium, looking for a market maker buy model, which is in alignment of the overall range. And so here I'm going to drop down to the weekly chart just to make it look a little clearer. But just so you know, there is accumulation. This is origin consolidation right there. This is your distribution phase 1. Distribution phase 2 is down here. You have your smart money reversal, and then you have your accumulation phase 1 here, and then we hit that range high of the yearly chart. And so I'm going to show you guys this on the weekly chart just so it looks a little clearer and easier to explain to you guys. And so now that we drop down to a weekly chart, it suddenly looks a lot clearer. So from here on the weekly chart, you can see that we have that market maker buy model that I kind of used as an example in the previous lecture. So here we have that origin consolidation once again. And then we have our distribution phase 1, distribution phase 2. And we have our smart money reversal over here, right? This impulse structure as I highlighted previously. Then we'll have our accumulation here. So once again, exact same thing I'm annotating, but now you can see the narrative of price, and you can see why it's important to understand the narrative, right? So that's why I say that entry models are very overrated in my opinion, because they limit you to a mechanical sequence that doesn't always happen, and it will limit you to a specific entry that, you know, once again, won't always be there. You won't be able to capitalize on the market even if your narrative is this good. So you have everything in alignment. So you have your higher time frame range. You understand that a market maker buy model is forming in alignment of your higher time frame range. So you can look for a continuation higher. But if you had a mechanical entry model, a lot of the times what people find is they won't have their whole checklist checked off and they can't execute because of that. Whereas in turn, if you understand the narrative of price, you can quite literally execute anywhere as long as you know the bias of price. So let's say this impulse structure occurs. I understand that price is going higher. I can buy down here and put my stop loss somewhere that I know it's obviously going to be invalidating my trade idea. So let's say if price drives below these lows over here, then I expect price to continue lower. If that's not the case, I'm expecting this original consolidation to be hit, and I just put my position like that, right? Vice versa, not vice versa. Continuing on in this trend, let's say you have a minor pullback here and you want to enter on this position right here. Well, you can do the exact same thing. Your risk to reward won't be as good if you do this, but understand that you're still making money. As you become more of an advanced trader and understand different things to look for, then you can refine your stop loss and increase your risk to reward ratio, right? But until then, you just need to really focus on the narrative, understanding where price is going, because once you understand the narrative, you know when to expect manipulation, consolidation, and expansion. So here, because we understand that there's an original consolidation here, we could expect a market structure shift, creating the shift in sentiment into sell side of the curve from this high, right? Once that occurs, we understand that this could be the first distribution phase because we just took out an accumulation phase on this side, right? Accumulation phase over here, distribution phase over here. And then because we understand that this is most likely going to be our distribution phase, we can expect bullish price action despite the entire trend being bearish at this moment. We expect that bullish move to be manipulation, enter on it at a better opportunity, let's say at this high of this wick, put our stop loss once again at the top of this market maker buy model or market maker sell model previously, knowing that this is the invalidation level, targeting equilibrium of our higher time frame range or a discounted target that will be taught later in this mentorship. But once again, this is the narrative I want you guys to understand why we make decisions in the market is because of this right here. Higher time frame range is our narrative. So okay, that's building block number 1. Intermediate term time frame market maker model. Okay, that's building block number 2. And then finally, if you want to trade each of these individual phases of their own, then you would once again drop down to an even lower time frame. And so let's focus on this piece of price action right here. This blue box. If I were to drop down to a 4-hour chart, right, once again, just like the previous lecture, I annotated this market maker model, then you would understand that this blue box is just an accumulation phase of the higher time frame market maker model. Once again, if I were to draw out the range of the weekly chart right here using impulse structure, right? So if we use impulse structure, we understand that this low responsible for this push higher up to this high, right? So we're applying the exact same concept here. And so we're just fractalizing it so we can capitalize on short-term movement versus long-term movement. When your lower time frame is in alignment of your higher time frame, that is high probability. You must make sure that you are in alignment of your higher time frame always. Otherwise, you will be blindsided and you'll just be, let's say, for example, let's say the market is so bullish here because of the higher time frame context, right? Without that context, someone could think that this is bearish price action and constantly trying to sell off as price is pushing higher, and that's how you blow your account because you don't have context of the higher time frame, and that's the importance of it. So enough rambling from me. This would be the impulse structure of the weekly chart, right? And so dropping down to the 4-hour, once again, you can see exactly how this applies the same way. We trade into a equilibrium or discount, right? Once we trade below equilibrium, that's discount, right? And so you can see the exact same thing occurring right here as we just did on the yearly chart to the monthly or weekly chart. We have a market maker sell model kicking off right here. Market structure shift, indicating that our market maker sell model is starting. And so if you were to capitalize on the sell move, this down move, sell side of the curve, then you would be targeting either equilibrium or a target down in discount. And once again, those targets will be taught moving forward in this mentorship. But I just need to get you guys into the idea of knowing how price moves. So this market maker sell model completes, let's say it completes over here at this original consolidation down here. And then once that occurs, you look for buy side of curve once again, and you can see how explosive price is when it's in alignment of the higher time frame. So this down move was not in alignment of the higher time frame for the overall trend, but because you still know that this is a manipulation in price, this is the down move, the manipulation before the up move, which is the true expansion of the market of the higher time frame, right? So I hope that makes sense. I want you to go in your own charts and find examples of this, because you'll find examples of this everywhere. And make sure to use the time frame alignments taught in the lecture as well. So as a day trader, I would highly suggest using weekly to 4 hour to 15 minute, or daily to hourly to 5 minutes. So those are the two main time frame alignments I would highly suggest you guys use and start practicing on now. All the other time frames will be applying these concepts the exact same way. However, the two alignments that I just told you, the weekly to 4 hour 15 minute and the daily to hourly to 5 minute, those two time frame alignments are the ones we're mainly going to be using on an intraday basis. That's all for this lecture, and be sure to study this in your own charts, because this is the bread and butter model that will be used to trade and actually make money for us at the end of this mentorship. As always, the homework and quiz for this lecture will be posted in the description below. Don't cheat yourself of this learning opportunity. Study and do the work honestly. I promise your hard work will be rewarded. Your assignment for this lecture is to go into your charts and annotate as many examples as you can from a top-down analysis perspective. Moving forward, you will be continuously annotating this model, but just applying each individual concept you learn along this mentorship. See you in the next one, and as always, have a great day.